Hello everyone, a very good evening to everyone. I hope you all are fine and doing well. So, today is the second class, and before we begin today's session, I want you to remember one thing. The CIIB examination is not a test of how much you know, it is a test of how consistently you have prepared. The exam is not standing between you and success. It is standing between you and your preparation. So let's strengthen our preparation from today. So you have the power to achieve anything if you set your mind to. So be confident, believe in yourself, you can do it. You can check out CAIIB BFM June 2026 Capsule Batch. Medium is there in English, where you will get 5 hours plus live marathon session. You can connect with the mentors and aspirants. You will get 10 full length mock test plus AI analysis and 360-degree study kit for revision. So, we are on NRI banking yesterday, right? So let's move to the NRI banking slide. Here it is. NRI banking. So what is the meaning of correspondent banking? What is the meaning of correspondent banking? And I told you that the correspondent banking is, can you tell me that what is the meaning of this correspondent banking? See, I told you this thing that the meaning of correspondent banking is simple, you can say, where the bank from one country gets the services from the another bank's country, because for every bank it is impossible to open the branches everywhere. So they use the concept of correspondent banking. Now the thing is that what is the meaning of NRI banking? Why this NRI banking is important? What is NRI? NRI is simple. India has a very large number of people who are living abroad, right? These peoples, these peoples may be working abroad, doing business abroad, they are settled permanently abroad, or they are studying abroad, right? And they also working in the multinational organizations. So such people send money back to the India regularly, and that is called what? Remittances. That is the concept of remittances. Clear? So foreign exchange reserves are very important. RBI and Government of India created special banking facilities for these type of people, and this is called NRI banking. So why this NRI banking is important? Because it helps in bringing foreign currency into the India, increasing forex reserves, helping the NRIs so they can invest in the India, providing banking convenience, facilitating international money transfers, and supporting the Indian economy. And what are the laws that supports this NRI banking? FEMA 1999, Income Tax Act 1961, and RBI guidelines. NRI is having different definition according to the FEMA and according to the Income Tax Act 1961, right? So what is the meaning of NRIs in Income Tax Act and FEMA? So NRI as per Income Tax Act. Income Tax Act decide NRI status mainly based on number of days stayed in India. According to the Income Tax Act, a person is staying in the India, that decides the status of that person. If a person is treated as resident, so he or she have to complete these conditions, stayed in India for 182 days or more during previous financial year, or stayed in India for 365 days or more in the last 4 years, and 60 days or more in current financial year. Either fulfill this requirement or this requirement. This is a choice between these two requirements. They are called then resident. If Mr. Rahul stayed 400 days in India during last 4 years and 70 days in current year, thus he becomes resident because both of the conditions are satisfied here. Right? So this is according to the resident who are under the Income Tax Act. But non-residents under the income tax, Income Tax Act decides NRI status, mainly how many number of days stayed in India. So this is the condition, clear? Now non-resident, who are the non-resident according to the income tax? If the person is not able to fulfill the resident conditions, that is called NRI according to the Income Tax Act. Right? And a very important amendment comes on 1st of April 2020. That amendment is earlier resident days limit is 182 days, but now it become 120 days. So this is a big amendment. In some cases 120 days is there. So according to the new rule, if a person stays in India for 120 days or more, right, and stays 365 days in previous 4 years, so income of these persons exceeds 15 lakh. So these type of persons are resident and they are considered resident for the tax purposes. They are considered the resident for the tax purposes. Right? Okay. Now, what is the meaning of SNRR account? So, basically, for SNRR, you can say SNRR. For learning the SNRR, we will learn about NRE account, NRO account, FCNRB account. So let's learn first about these accounts. Just a second. Okay. So before starting, moving to the NRE or NRO account, you know about one term, that is RNOR. RNOR are who? These are the residents but not ordinarily resident. Who are they? And I already gives you a glimpse about RNOR in the yesterday's class. So basically a person become RNOR if they have if they qualifies some conditions. What condition? Condition 1 is they stayed in India for 9 years out of, they stayed 9 years outside. 9 years outside out of 10 years. Right? First condition is that. Or they stayed in India for less than 730 days during the last 7 years. Or third condition is there, if the PIO Indian citizen, like their income is greater than 15 lakh, they are stayed 120 days or more in India, they stayed 365 days or more in preceding 5 years or preceding 4 years. So deemed resident is considered who are having the income above 15 lakh. So all these categories comes under RNOR. They have to qualify any one condition, right? First condition is 9 years out of India from the last 10 years. Second condition is they stayed in India for less than 730 days for the last 7 years. Then their income must be more than 15 lakh. They stayed 120 days or more in India. So they are considered as deemed resident, right? So a person becomes deemed when he is Indian citizen, not the tax resident in any of the country, and income from India exceeds at least 15 lakh. Then India treat that type of person as resident for tax, right? And deemed residency only applies to Indian citizens only to the Indian citizens, not to the PIOs, right? So under the FEMA, focus is not mainly on the number of days. According to FEMA, according to the income tax, we have to consider days. But according to the FEMA, the focus is not on the number of days. Here, the focus is on the intention and the purpose of stay abroad. According to the FEMA, NRI is the person who is outside the India, a person resident, if he or she is outside the India, if he is Indian citizen or person of Indian origin, and he is staying abroad for employment, for business, for profession, for any type of vocation like learning the new skill or any other purpose where that indicates indefinite stay abroad. There is no timing that he or she will come in that time period. If he is staying abroad, that is considered as NRI according to the FEMA, right? If someone goes abroad for the job, for the business, for the long-term settlement in the Canada, then that type of person become NRI according to the FEMA. So if any person staying abroad for higher studies, they are also treated as NRI according to the RBI guidelines also, even though their stay may not be permanent, right? So who are included as NRI? Those person who are doing job abroad the India, abroad India, like from outside the India. If any employees who are working in UN, United Nations, World Bank, or International Monetary Fund, this is also an organization, these all three are the organization. Any government official who is in the abroad, or students who are studying abroad, right? These all are considered as NRI according to the FEMA. But if any tourist going abroad for a short visit, that is considered as NRI according to the FEMA? No. If someone going to Germany, USA for 10 days, for 1 month, so these type of people are not considered as NRI according to the FEMA, right? So income tax focuses on the number of days, whereas FEMA focuses on the intention of staying abroad or not. Then we have one term, this is PIO. What is the meaning of PIO? PIO is person of Indian origin. Person of Indian origin. Person of Indian origin means any person who is the citizen of another country but has a India roots or origin. Person is living in any other country, but that person having the roots of India roots or India's origin. Like A person, uh, who can be these types of person? A person who is resident earlier, resident earlier in India, or citizen of the India in the early time, or whose uh, parents, grandparents, or great grandparents are Indian, right? Or uh, if any territory belonged to India before 1947, these are also considered as the Indian citizen. And also foreign spouse of the Indian citizen. Foreign spouse of the Indian citizen. So a person who is having attachment in the India, and that person is the citizen of any other country, so that type of person is called PIO. But in this we have the exceptions: citizens of Bangladesh, citizens of Pakistan, and some other specified countries, especially these two, Bangladesh and Pakistan, are generally excluded unless they are specifically permitted, right? Same one term is there about OCI card holder. Who are the OCI card holder? See, what is the meaning of OCI? Obviously, overseas citizen of India. What is the meaning of overseas citizen of India? See, OCI holders are also treated as PIOs for the banking facilities, right? PIO means person of origin, right? So PIO are the person of origin. So I told you, PIO citizenship, you can say they can refers to the foreign citizen, but they have the roots of India. So they are not Indian citizen, they are the foreign citizen. If we say what is the like citizenship of PIOs, they are foreign citizen. They are not Indian citizen, right? They refers to a foreign citizen, right? But they have roots in the India. You can say they have the ancestors of the India. So who are the NRIs? Indian citizens staying abroad. PIOs, foreign citizens with Indian origin. OCI, special overseas citizenship status, right? Same with the overseas, one word is there, overseas citizens. You can learn about overseas corporate bodies. Overseas corporate bodies means foreign companies, trust, firm, mainly owned by NRIs, right? When the foreign companies, trust, firms mainly owned by the NRIs, and minimum they should have 60% ownership by the NRIs. 60% of ownership. So basically in India, RBI disconnected OCB investment facilities from 16th of September 2003. Right, OCB cannot make fresh investment freely. They have to take the approval from RBI. Then there are many types of NRI accounts. Types of NRI accounts. And in this, first account type is NRE account. We will discuss later about these account. NRI account, just learn the types of NRE account. This is non-resident external rupee account. Then we have next account, which is NRO account, FCNR B account, and SNRR account, right? So NRE is there in the Indian rupees, NRO in the Indian rupees, FCNRB in the foreign currency, as you can see FCNRB. So this is in the foreign currency. SNRR is in the Indian rupees, except FCNR, all are there in the Indian rupees. And bank generally obtain passport copy, visa, employment proof, overseas address proof, application form, and the declaration regarding returning to India. Then they will open the NRI account, right? So what is the meaning of this NRE account? Why this account is special? This is non-resident external account. Non-resident external account means, you can say, one of the most common type of account, right? Most common type and most important type of account. So this is the rupee account. NRE account is the rupee account, and this rupee account is related to the NRI who funded from foreign earnings and remittances. All the foreign earnings and the remittances are stored in this NRE account. Money comes from outside India. An account is maintained in Indian rupees. And what are the sources of the NRE account? Like, NRE account can be opened through the foreign remittances, from the telegraphic transfer, from the foreign checks, from the another NRE or NRO account, and foreign currency which is bought in India during visit. So it can be a simple saving account, it can be current account, it can be recurring account, or it can be the fixed deposit account. And minimum period for these types of accounts will be 1 year, minimum 1 year, right? And yes, this account can be opened jointly with another PIO, with another NRI, or even with another resident relative. But for resident relative, this is on the former survivor basis. What is former survivor basis? This means when the actual holder of the account is not there, like death of the actual account holder, after the death of the actual account holder, that resident relative have the power of this account. Then the power is transferred to the resident relative, right? So this is the former survivor basis. So resident relative can open account only as power of attorney holder during the NRI's lifetime, right? And what are the allowable credits in this? In this, foreign remittance can credit interest earned, any type of maturity proceeds, any type of rent, dividend, pension, interest, transfer from the NRE or NRO account. And tax must be properly deducted from this. This account is taxable. And apart from this, debits are also allowed for local payments, for remittances abroad, to transfer to another NRE or FCR account, or investment in the India, right? So in this, all the facilities are available. Checkbook facility is available. Full repatriation. Repatriation means money can be sent back to abroad, right? Nomination facility is there. Tax benefit is there. Interest earned, whatever the interest earned in this account is exempted from the income tax, right? And power of attorney means resident power of attorney holder, they can withdraw the money for the local payment, and they can also remit to account holder abroad. But they can't open NRE account, they can't gift from this account, they can't transfer the money, they can't repatriate to third party abroad, they can't do repatriate also. And here overdraft is available up to rupees 50,000. 50,000 overdraft facility is also available. But that overdraft must be cleared within 2 weeks, either using by foreign remittance, either by another NRE or FCNR account, right? So NRE account must be can be converted into the resident account if that person, if that NRI come back to the India, returns to the India, right? Immediately after return for the permanent settlement. So this account is in the rupees, and whatever the exchange risk is there borne by the depositor. So that is about the NRE account. Now NRO account. What is the meaning of NRO account? NRO is non-resident ordinarily account. Non-resident ordinarily account. This account is mainly for the income earned in the India. Whatever the income earned in the India, the main aim of this account is that if an NRI is having rent income in the India, pension, interest income, insurance maturity, such income generally comes in this NRO account. So when resident becomes NRI, whatever existing normal saving account is converted into the NRO account. And same in this current account, saving account, recurring deposit, term deposit facilities are available. And whatever the interest on the NRO account is taxable. Even TDS is also applied. It can be opened jointly with the resident, NRIs and PIOs, right? And whoever the foreign tourists, they can also open the NRO account during their temporary stay, right? And here NRO balances can be repatriated, but only up to $1 million per financial year. This limit is there. In NRE account, full repatriation facility is there, but in NRO, $1 million per financial year facility is available. Clear? So, what are the conditions of the repatriation? They have to do the tax payment. They have to fill forms, some forms related to the terms and condition. And if someone wants to transfer from NRO to NRE, so there is also this limit applicable, $1 million per financial year. Nomination facility is available, power of attorney facility is available if any foreign tourist opens the account. So that account should not be open for more than 6 months, right? And if that person, that NRI returns to India, so again NRO becomes resident account. Clear? Now third type is FCNRB. FCNRB account. Now what is the speciality in this account? This is foreign currency non-resident account. So what is it? Basically, I told you this account is maintained in the foreign currency, right? Not in the rupees. And types of currency can be US dollar, British pound, Japanese yen, euro. And these types of account can be only opened as fixed deposit. Only as fixed deposit. Minimum period must be 1 year and maximum period must be 5 years. 1 year is minimum, 5 years is maximum. And there is no exchange risk to the depositor because obviously deposit made in foreign currency. So repayment also in the same foreign currency. And here rules are same for the like NRE account, for the joint account, and here no exchange risk is there, full repatriation allowed, interest is tax free, and interest is calculated on 360 days basis. This is learnable thing because in numericals we generally confuse when we do the calculation. Always in this, interest is calculated on 360 days basis and compounded half yearly compounded. So learn this thing. Sometimes they ask the question from this. Nomination facility is available and forward cover facility is available. What is the meaning of forward, people? forward cover protection against future exchange fluctuation. Right? If any resident who is having the power of attorney, that resident cannot operate for local withdrawals. Right? And one more famous account is RFC account. What is the meaning of RFC account? RFC account is resident foreign currency account. Resident foreign currency account. So this account is only for the returning NRIs. An NRI returning to the India permanently can open this account. It can be saving account, it can be fixed deposit. Joint account is allowed with resident relative. Right? Resident relative, it can be open. And it is for receiving the pension income, pension or income maturity, any insurance maturity, for foreign income and assets. So income tax interest rate is exempted here, interest tax, full repatriation allowed, no restriction on the usage. So I will provide you a table where you will see the difference between NRE, NRO, FCNRB, RFC and the SNRR account. So it will be very helpful for you. So I will prepare a table and present to you, right? So returning NRI generally enjoys RNOR status for first 2 years. Keep this thing in mind. Who are the returning NRIs? They enjoy RNOR status for first 2 years to get tax benefit. So NRE account is external earning account, which is in the rupees and tax free. NRO is ordinary Indian income account, taxable. FCNR is in the foreign currency, no exchange risk is there. And RFC for the returning NRIs, foreign currency account, and RNOR benefits are there. Right? Is that clear? Now, special non-resident rupee account. It is called special non-resident rupee account. Why? Because many foreign companies and foreign persons do temporary business in the India, obviously. So these people need temporary rupee account for the business transaction in the India. So RBI say to those types of people who are temporary doing business and the foreign persons, they can open SNRR account. Any person who is residing outside India but having the business interest in the India, they can open SNRR account. And what is the purpose of the SNRR account? Bona fide business transactions in rupees. Bona fide means genuine, real, legal transactions. Transactions should not violate FEMA, RBI guidelines and the government regulations. So what are the important features of this SNRR account? So, first thing is there must be specific business purpose account. Specific business purpose account means SNRR account have to carry name of the specific business activity. Right? If the foreign company comes for metro construction project, then account may be named accordingly. And it does not earn any type of interest. Transactions, whatever the transactions are done, they have to match the business activity. Right? They have to match the business activity. Means whatever the credit, debit, balances, they should be match with the business activity. Transaction should match actual business needs. If a company has small project in India but huge unexplained transactions are happening, so bank may suspect the violation. And fourth important thing is RBI compliances are necessary. RBI compliances are necessary means authorized dealers, banks, they have to ensure all the transactions are following FEMA, RBI rules and government regulations. And what is the tenure of the SNRR account? Basically, SNRR account have to match the contract period, whatever the contract period or business period of the particular company, but maximum period tenure is 7 years, and no operation is allowed after 7 years. So what is the maximum tenure in the SNRR? 7 years, right? Then repatriation is allowed, right? Money can be transferred abroad, and in this, transfer from the NRO account to SNRR account is not allowed. NRO account transfer to SNRR account is not allowed. Taxes are applicable, and if suppose the holder become resident, so in that case this NRR account become resident rupee account. And if suppose the account holder is dies, so in that case whatever the amount payable to the nominee will be credited to the NRO account of nominee. And in the case of Bangladesh and Pakistan, they have to take the approval from the RBI before open this account, right? Before opening this account, they have to take the permission from the RBI. Is that clear? I will give you the table in the PDF, so that will also help you in see the difference between different types of account. Now, international credit cards for the NRIs. Authorized dealers, banks can issue international credit card. To whom? To NRIs, to person of Indian origin without RBI prior approval. They don't need RBI approval in this, right? So, and one more thing here, I am going to tell you one more thing. Tomorrow 7 a.m. we are having module A marathon class. Marathons means where we will learning numericals, case studies, and as well as some questions, important questions related to module A. So kindly join on YT at 7 a.m. sharp. Okay, we will discuss 20-30 questions which are helpful. So it will help you to learn the things, right? And we will try our best today to complete this module, because it is important to complete this module today. So how are credit card payments settled? Payments can be made from inward remittance, FCNR account, NRE account, NRO account, right? So this is the international credit card facilities for the NRIs. But one more thing is there. Okay. Here, what is the income tax requirement? Like, important thing is income tax requirement. See, bank allow remittance from NRI account only after required tax documentation, and forms are prescribed by CBDT. What is this CBDT? Central Board of Direct Taxes. And government want NRI to invest in India. Why? Because India get in that case foreign exchange, economy grows, capital inflow increases. So NRIs are allowed many investment facilities, and NRI investments are governed by FEMA regulations, foreign exchange management, right? So there are two types of NRI investments. First is on the repatriation basis, and second is on the non-repatriation basis. In the case of repatriation, money and profit can be taken back abroad, right? But in non-repatriation basis, money cannot freely move abroad. Usually it is treated like domestic investment. Suppose if any NRI invest 15 lakh, right? If repatriation basis, that 15 lakh can be taken back, whatever the principal, profit, sale proceeds abroad, right? If non-repatriation basis, so money remains in the India. And if there is any investment in the shares and securities, then NRI can invest in shares, debentures, convertible debentures, bonds, mutual funds, everywhere. Most of the sectors are open for the NRI investment, but some sectors are there, they require RBI approval. Some sectors require RBI approval. So whatever the investments are there on the repatriation basis can be made from foreign inward remittance, from the NRE account, from the FCNRB account, right? And major categories of investment will be like FDI, foreign direct investment, portfolio investment scheme, and non-repatriation instruments, some other securities. And what is this portfolio investment scheme? Where NRIs and PIOs, they can buy and sell the shares through the stock exchange under the PIS scheme. And yes, they NRI have to open an account only in one designated bank branch, right? And what is the investment limit? What is the investment limit under this PIS scheme? So some questions will be there from this. So if one NRI is there or one PIO is there, so they can invest 5% of paid up capital. 5% of paid up capital of the Indian company, of that Indian company. 5%. But overall limit can't exceed more than 10%. Right? So this is the thing here. And apart from this, basically NRIs, there are lots of facilities available for the NRIs, and some restricted countries are also there. They need RBI approval before doing any type of investment. Suppose these countries are Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, Iran, Nepal, Bhutan. They need RBI approval, right? And I think one more thing is there, that is housing loan facility. Housing loan facility to the NRIs. So yes, bank can provide housing loan to the NRIs for the residential property in the India, right? And what are the conditions for the housing loan? It is same as residents. Yes, it is same. Loan amount, margin, repayment period can be same as resident Indian. And loan cannot be credited to their FCNRB account, not allowed, and also to the NRE account, right? And loan must be secured by equitable mortgage, like proper property documents deposited with the bank as the security. Repayment sources can be foreign remittance, NRE account, FCNRB account, NRO account, rental income. But there are some property transactions also there for the NRIs. They can't purchase agricultural land. They can't purchase plantation property. They can't purchase farmhouse without approval. They can't do real estate business. They can't trade in TDRs, transferable developmental rights. They can't open public provident fund. Right? So this is the thing here about the NRIs. I hope that this thing is clear. If any doubt is there, you can ask me. Then we will move to the next chapter here, which is IFSC. So we are covering 9 and 10 chapter first, right? Then we will cover rest of the chapters. So IFSC, International Financial Service Center, and also Gift City. Suppose a company in the India wants to borrow money from foreign investors and issue the bonds internationally, manages foreign currency risk, or raise funds globally. Normally, these types of activities happens in the global financial sectors like Singapore, Dubai, London, Hong Kong. So India also wanted a similar world-class international financial hub, and that's why India created IFSC. That's why India created IFSC. What is IFSC? An International Financial Service Center, a special financial zone in India that provides international financial services to the customers who are located outside India. So this IFSC only deals in foreign currency transaction, only in the international finance, only in the cross-border business, global investments. So it is a financial world inside India that works like the international financial market. And what are the main purpose of IFSC? It focuses on the flow of money, investment, financial services, financial products across the different countries. So what are the main activities? Like what are the main purpose of these activities which are performed in the IFSC? First is fundraising services. Fundraising services means it helps individuals, companies, governments to raise the money from international market. How? Let's see the example. Suppose there is an Indian company. Indian company wants to borrow US dollars from foreign investors instead of borrowing in India. So the IFSC helps in arranging such international borrowing, right? Asset management and portfolio diversification. So what is this? Here, big financial institutions like pension fund, insurance companies, mutual funds, they invest their money globally. Why? To reduce the risk and increase the returns. And this is called global portfolio diversification, right? Suppose a mutual fund invest in US stock, European bond and Asian market instead of investing only in India. Also, wealth management. Wealth management, managing the money of rich individuals or institutions, right? If there is a high net worth individual that wants to invest in foreign share, bonds and gold internationally, so IFSC institutions can help, right? And then global tax management. Companies who are doing business in many countries, they want to reduce their tax burden legally, right? So that creates opportunities for the banks, financial consultants, chartered accountants, law firms. Then corporate treasury management. Corporate treasury management, managing the company's funds efficiently. Risk management operations, like doing all the things related to the management of risk. Merger acquisition activities. Large multinational companies, they merge or acquire companies across the countries, and IFSC provides financial and legal support for such type of international deals, right? So what is the scope of IFSC in the India? India created IFSC to become a global financial hub. And the major IFSC in the India is Gift City, Gujarat International Financial Tech City, which is started from 5th of December 2019, which is there in the Gandhinagar, Gujarat. And why this IFSC needed in India? Because India has many financial restrictions. Lots of finance, like huge demand of SLR investment, partial capital account convertibility. So these restrictions, many international transactions moved outside India. So that's why India created a zone where all these international financial transactions happen smoothly. Right? What is special economic zone? It is a designated area in a country that's subject to more favorable economic regulations. And these SEZ supports IFSCs, right? And what are the tax benefit in the IFSC? Uh, this is an exemption from the securities transaction tax for certain transactions done by a non-resident through IFSC. Uh, what is the meaning of this STT? That securities tax, transaction tax, STT. So STT basically a type of direct tax which is uh, applied by government on the purchase and sale of securities, right? On the recognized Indian stock exchanges. So this is STT, right? So why this gift city is important? Because India wants gift city to compete with these global financial hubs. So India require gift city also. Its main objective, creating global integrity, supporting Indian economy, become Indian financial destination, international financial destination, and also international finance businesses to the India that helps the economy to grabbing more foreign exchange reserves. So what are the opportunities are available at this gift city? First, access to large Indian economy. Foreign investors can connect directly with the India's large market. Indian business can connect globally through IFSC. And around 30 million Indians are living abroad. They can invest, they can connect financially with India through the IFSC. And Gift City act as uh, like inbound gateway, outbound gateway for the international finance. Also, companies can establish financial operations centers gift in the gift city because operating cost is globally competitive. And Gift City aims to become a world-class financial technology hub, right? And managing the global investment fund can help a major business opportunity, right? So these are the opportunities which are available at the gift city. Now segment wise business opportunities. First, we have wholesale uh, wholesale banking opportunities. Wholesale banking opportunities. In this, we include ECB as opportunity. ECB, external commercial borrowings. Simply learn when the Indian companies borrow from foreign lenders. Then trade finance, factoring. These are the opportunities available at wholesale banking. Trade finance, like financing import and export transaction. Factoring, like selling, like where export sells their invoices to the bank and get instant money. Forfeiting sibling is a factoring sibling is forfeiting. What is forfeiting? Forfeiting is long-term exports receivable financing without recourse. And it is generally used in the international trade. Factoring and forfeiting, though two important concepts. So generally in typically these allows to exporter sell their foreign invoices or debt instruments to the financial institutions. Forfeiting is mainly for the long term and factoring is for the short term. Then syndicated loan and aircraft leasing. Syndicated loan means large loans which are provided jointly by the multiple banks. And aircraft leasing, financing aircraft purchase on leasing. Right? So, what are the capital market opportunities These are the wholesale banking opportunities. Now, capital market opportunities are also available. What are these? Capital market opportunities like merchant banking, stock exchange participation, custodian service, any type of alternative investment funding. Then retail banking opportunities. And in retail banking opportunities, we can include private banking, wealth management, structured deposits, and certificate of deposits. Right? And apart from this, there is one more opportunities, that is treasury management opportunities. In treasury management opportunities, it includes ALM management, forex derivatives, credit derivatives, and a type of interest rate derivatives. So these are the opportunities which are available at different segment. Clear? Now, what is the guideline? What are the guidelines? How to set a IFSC banking unit or a IBU? How can we set? So, first thing is there. What is the meaning of non-deliverable forward? Which you can see, say in short, NDF. What is the meaning of non-deliverable forward? It is also a derivative contract where actual currency delivery does not happen. Where actual delivery is not happen, it is usually used in heavy international forex market. Now, what is the meaning of this IBU? IBU is a branch or a unit of bank that operating inside the IFSC. And who can open IBU? Public sector bank, private sector bank. They are authorized to deal in the foreign exchange. And one important rule is there, each eligible bank can open only one IBU in each IFSC. And they need the approval from the RBI to open the IBU. An IBU is treated similar to the foreign branch of Indian bank. But what is the requirement of capital? Parent bank must have the capital, must have the provide capital of minimum $20 million to the IBU. And this capital must be maintained all the time. And IBUs are not required to maintain CRR and SLR, and one of the major advantage. So from where the funds can be raised, from the non-residents and from the overseas branches of Indian banks. IBUs can also lending to residents in the India, to non-resident, but Indian resident have to follow FAME. Right? So there are no cash transaction, there is no saving account, only current accounts are there, term accounts are there. India's KYC and AML norms are applicable. Deposits are not insured. IBU deposits are not covered by deposit insurance. Right? Then IFSCA, International Financial Service Center Authority. It is a unified regulator for IFSC activities in the India. And before the IFSC, multiple regulators handled the IFSC. Who? RBI, SEBI, IRDI, PFRDA. They created coordination difficulties. This created because lot of regulators are there. So now IFSCA regulate the IFSC. Right? So that's why government created only one single regulator, which established on 27th of April 2020. Headquarters are there in Gandhinagar, Gujarat, and main objectives they can do is easily business, they can do world-class regulatory environment, global financial connectivity, and support Indian economy. And Indian and foreign banks need IFSC license if they want to open IBUs. right? And I told you the parent bank who is going to open the IBU, they must have the must have to maintain the capital of that unit in the IBU, US dollar 20 million. They have to get the certificate of NOC from home country regulator. Parent bank have to assure liquidity and support to the IBU, right? So what are the liquidity requirements now? Liquidity requirements, simple. We know that IBU are not able to maintain CRR and SLR. They are exempted from this, but they have to maintain LCR and NSFR. LCR is liquidity coverage ratio, which ensures short-term liquidity, and NSFR is net stable funding ratio, which ensures long-term stable funding, right? And IBU have to maintain 3% of their retail deposits daily. Of their retail deposits, they have to maintain 3%, right? And what are the permissible activities? IBUs can transact with resident, non-residents. All the transactions must be in the foreign currency only. IBUs cannot deal in the INR. IBUs can maintain special INR account only for administrative expenses and for the statutory expenses. Saving accounts are not allowed. Current accounts are allowed, right? And they only do the transaction through the bank transfer, right? IBU have to take permission from the RBI before offering the derivatives, right? They have to take the approval from the RBI before offering the derivatives. But there is the exposure limits also. What are the exposure limits? Simply, exposure single, if there is a single borrower, then 5% of parent bank tier 1 capital, and in the case of borrower group, so in the borrower group, this percent become 10%. This is the exposure limit. And IBUs have to follow all the RBI instructions regarding anti-money laundering, regarding combating financing of terrorism. And IBU, they can't participate in any type of domestic call money market, domestic forex market, domestic payment system, right? Because why? Because they are designed mainly only for the international business, right? And if IBU is facing any liquidity problem, RBI will not provide any type of liquidity support, right? So one more thing is there. What are the relaxations? Just a moment. What are the relaxations provided to the FPIs, foreign portfolio investors? These are those investors who are investing in that trading Indian securities. So benefits are given to the FPIs. They can trade on the IFSC exchanges. They can do trading. They can do commodity derivative trading, right? And there is no type of STT tax and no type of commodity transaction tax, right? And they don't give to any additional document. They are not required to provide any additional type of documents. And also there are tax benefits for them also, very attractive for the foreign investors. So it is clear about the IBU. So let me tell one thing, when I provide you the PDF, so you want the memory tricks or not, or the final summary of all the chapter. So if you want this slide also in your notes, so kindly let me know. So I will add from today. I need your suggestion in this. Now, digitalization. What is digitalization? UPI. We are using internet banking, we are using net banking, we are using mobile banking. All are the examples of digitalization, right? And you can see the craze of digitalization in the banks or even in the world, right? We can go outside without our purse, but we can't go outside without our phone, because this is the era of the digitalization, right? So basically we can say digitalization means when we use the technology and the digital system to perform banking activities very conveniently. Earlier, if we compare the earlier banking with modern banking, you can see lots of differences are there. And because of digitalization, everything become too fast and too convenient for the customers. Youth, youth is not interested in going the banks, right? So banks customize the product for the youth and also provide lots of services on the mobile. And this is all because of digitalization. Even every bank is having their board app now, where they can ask their basic questions, right? So digitalization also change international banking. And you can see technology is increasing, technology is growing, and everyone is know the importance of technology. And even banks today, they face the competition from startups, fintech companies, internet giants. So if banks do not adopt technology, so the youth will interested in that bank? Obviously no. So bank have to follow the trend. They have to adopt the technology, right? So how to build a truly digital bank? How the bank can be digital? Yeah, yesterday classes edit. From today, I will add all the memory trick and all the final summary. So it will help you to revise the chapter, the notes. And sorry for yesterday, but from today, after the class, whenever the class ended, give me at least half hour uh, before, because I have to summarize all the things and I have to add all the things. It take half hour. Then I will upload from today all the PDFs after the class. Okay. So, building a truly digital bank. What does it means? See, a digital bank is not just a bank with internet banking. A truly digital bank completely designs what is the need of the customer. What are the technologically system? What are the banking operations? What are the internal processes? Organizational structure. And the why the bank is going for this? Bank is going for this a faster banking and seamless customer experience, right? And also for the internal processes, organizational structure, for lower cost, for better compliance, and even for more business growth. So what are the important areas in building a digital bank? First is rethinking customer experience. Obviously customer experience is must. Bank have to understand what customers want and how customers use the banking, which services customers expect online. And customers also want 24 into 7 banking, instant transfers, online trade services, quick foreign exchange booking, mobile based banking. So bank redesign their system accordingly. Then re-engineering banking architecture. Yesterday's class notes are uploaded. Please check. And if we compare with the old support, bank have to redesign their system. And this process is called digital re-engineering. Digital strategy. Every bank have to create their own digital strategy based on their vision, goals, their competition, their customer needs. Digital capability assessment. Bank have to assess current technology level, existing gaps, employment readiness, digital maturity, and transformation required. What type of transformation? Digitalization actually affects the organization structure, employees, technology, banking culture, process, assets, IT system, and IT architecture alignment. You can think like bank have to align their front office system, back office system, operational system, digital setups, everything for better customer experience. And digital re-engineering roadmap. Before implementing, bank have to prepare budget, timeline, resources, cost estimate, everything. And this is the concept of digital roadmap, right? So what are the broad thoughts for digital upgradation? Because shifting from the traditional banking to modern banking, and you can see in today's era how banks are advanced, and it needs lots of things. First is customer relevance. Because of customers, banks have to upgrade themselves. Now they provide flexible products, better digital services, customer friendly platforms. Then speed versus in-house talent. Bank have to decide, they have to build technology internally, or they have to become the partner with the fintech companies. Also digital ecosystem they have to create, all the services, all the products they have to connect digitally. Bank have to reskilled, give the training, retraining, reskilling, or new recruitment to their employees so they know what is digitalization. And become agile. What is the meaning of agile? Network issue is there, let me check. Just a second, allow me a minute. I think now it will work fine. So uh, now becoming agile. Agile means quick response, because youth want a quick response today. Even customers need quick response, flexible working, and also fast adaptation. And continuous monitoring. Banks should not blindly follow all the old plans. They have to regularly review the progress, self assess performance. They have to improve continuously, right? So how the technology is evolved. So quick overview of this. In the last cycle I saw a question from this, so let me tell you about this. In this we will divide, there are three types of period. First is pre-nationalization period. Pre-nationalization period, what is it? Before 1969, most of the banking activities were manual, right? Everything was handwritten. So technology is not there, banking financial inclusion is very low, populations were largely illiterate. But after the nationalization, in after 1969, government nationalized 14 banks, right? 14 banks. Why? Just to expand banking sector, just to promote the savings, just to support economic development, just to reach rural areas, right? So after the post nationalization, bank, many people still dependent on the financial intermediaries. You can see the intermediaries, money lenders. So why? Because in that time of nationalization, the banking access was still developing. And in the second phase of nationalization. During 1980 or after 1980, another 6 banks was nationalized. So demand for technology increased, bank want modernization. And how the technology introduced? First, they introduced ALPM, Advanced Ledger Posting Machines, which is started in 1980. And these machines automated ledger posting. These machines reduced manual entries, and that become the beginning of computerization in the banks. Right? In the computerization phase, data entry machines slowly converted into computer system. Now banks started electronic record, faster processing, digital storage, and then in 1990s bank adopted internet banking, online services. Then came ATM, credit card, debit card, slowly become the banking process become online. And present era, you can see digital era is the present era, right? Where you can see the AI, blockchain, chat GPT, UPI, Gemini, online remittances, digital trade finance. Somewhere I read uh, in our childhood we saw Doraemon, right? We saw the famous cartoon Doraemon's Shakalaka Boom Boom and now we use chat GPT for our problems or Gemini, right? So today we are using all these are the form of digital banking. Even banks have to adopt this fashion trend. So manual to ALPM to computer to internet banking to digital banking, right? But what are the benefits of this technology? Obviously accuracy is there. Accuracy, you can say speed is there, right? Or you can say there is very low transaction cost, ease of doing business, and other advantages. There is better compliances, better communication is there, easy communication, and that leads to reduction in manpower, right? And business continuity are also there because digital system help the operations continue in the time of emergencies, like you can say uh, COVID-19 situation, right? These are we can consider are the benefits of the technology, right? But what are the limitations of the technology? First, the cost is very high, high infrastructure cost. There is technical glitch and customer awareness issue. Everybody don't know about the technology. Everybody don't feel comfortable in the UPI, right? And also um, there are the limits, control limits applied that creates inconvenience. Like in UPI you can send only to up to 12 persons in a day, right? So security risks are there, cyber risk, hacking, phishing, whizzing. You can see these types of risks, right? So inward remittance online is, I think you know that when the money is coming into India from abroad. So how it works, NRI have to register on the internet banking, then they get ID and password, they add beneficiary details, they select purpose code, and then money is transferred online easily, right? This is the concept of inward remittance online. So Transfers are only from the FATF countries allowed, and they have to follow all the anti-money laundering norms. So benefit of inward remittance, quick transfer, fair exchange rate, 24/7 support. Same outward remittance when the money is going out from the India. So they also here we have to log in into the internet banking. We have to select Forex tab, add beneficiary, select purpose code, and enter the details and transfer the funds. So internal control limits are there. These are lower than RBI limits for the safety purposes. MT103 question is there in the last cycle from this MT103. MT103 is used when the customer to customer SWIFT transfer message, and it is used in international fund transfer. So what code is this? MT103. And yes, fast transfer, secure transaction, 24/7, permitted purposes, and education, medical expenses can be the purpose of remittance. So I'm trying to include everything from your all the modules. So I think we don't know the IIBF pattern. They can include anything. They can ask you anything. So don't worry, we will include everything. Either the class will go for 2 to 3 hours or 4 hours. It does not matter. It's just a talk of 7 days. So we can do. Don't worry. Now, world checklist. Bank screen the remitters. Like bank keep the eyes on remitters, on the beneficiaries. Are they following all the rules or not? And that process is called scrubbing or screening. Why? Just to prevent money laundering or terrorism financing. Now we are having trade finance portal. What is the meaning of trade finance portal? So this is a web-based online portal for import transactions. Import transactions, for export transactions. Import transactions, export transactions in the paperless form. Customers can initiate transaction, authorize transaction, track trade financing activities. And how many types of transaction? 2. Import, export. Right? So here we will do standardized transaction, bulk upload facilities available. Large corporates, they can upload many transactions together. Maker checker facilities available. One person create transaction, another approve it. So what is the purpose of it? Just to reduce fraud and mistake. Online SWIFT copies accessible. Online limit monitoring is there. Dashboard monitoring is there. They can track the pending items like IDPMS, EDPMS, forward confirmations. Then foreign exchange rate portal. What is it? Where the corporate customers, they can directly access what? Forex rates and bank dealing room online. And how many types of forex deals? Ready, term, spot, forward, right? So corporate have to submit underlying document, otherwise deal may get cancelled. And losses are recovered from where? From the customers. So bank takes one-time indemnity from the customer. Customer agree to compensate bank for the losses due to non-compliances. So there are real-time forex rate, master like MIS reports are there, market advisory is there. So what is this EDPMS? EDPMS is export data processing and monitoring system. So what is the meaning of this? This is introduced by RBI on 1st of March 2014. Right? Why introduced? To monitor the export declaration, for the shipping bills, for the export realization, and export declaration form, a shipping bill, and Softex is also there, which is software export declaration form, right? And here it reports all the advance remittance. It do the caution listing, like those exporters who are unrealized beyond 2 years. And here are the electronic bank realization certificate, which is introduced from October 2017. Then same portal is there, IDPMS, which is import data processing. This is for exports, but this is for imports monitoring system. And it is also introduced by the RBI. And the important feature of this, multiple remittances against one BOE. BOE is bill of entry document, which is filled with customs for the import. And ORM is outward remittance message. So multiple remittances are against one BOE allowed, and import of services is not covered under the IDPMS. Import of services, only goods are allowed. So then we are having firms portal. What is firms portal? Which is used for online reporting of foreign investments. Here online reporting of foreign investments are done, right? So single master form is there, which is introduced to integrate various foreign investment reporting structure, and FCGPR, foreign currency gross provisional return, which is used for reporting foreign investment. Then we have fintech. Fintech is financial plus technology, where we use the technology just to improve financial services. And fintech companies provide faster, easier, technology based financial services. You can see the example: mobile wallets, Paisa Bazaar, online lending apps, robo advisory platforms. So where we can see the use of fintech in banking, in insurance, investment, payment, risk management, and trading. And you can see the example of fintech tools: machine learning, fraud detection system, AI system, mobile banking apps, chatbots. These all are the examples of fintech. In India, there is a high demand of fintech. 2100 plus fintech companies are there. 67% established in last 5 years, 17% in the digital payments, 17% in lending, and 14% in the wealth management. And India is the second largest hub after the USA. Alag, different craze here. So what are the delivery channels under the fintech? First we have artificial intelligence, AI. Machines that simulating human intelligence, right? So AI helps in identify importers, exporters, trade customers. AI helps in cash flows, analyzing the business models, analyzing the global supply chains. AI predicts economic outcomes, trade risk. AI tells about the payment patterns, about the collections. AI helps in recovery analysis. And AI checks the credit worthiness and repayment ability also. And AI also do fraud detection. So artificial intelligence is one of the most important delivery channel. And then big data and data analysis, which means very large and complex data set. Data analytics means studying the data to identify patterns and insights. So basically, why it is used: to studying market trends, to understand customer behavior, predicting the risk, identifying the stable countries, and market strategy formulation. And we know that banks also use models to like to predict future by analyzing past patterns. So here we can say this is predictive analysis, where past data is used to predict future things. Then robotic process automation, like using the software robots to perform repetitive tasks. Instead of employees manually checking 1,000 transactions daily, software robots automatically perform the task. So robotic performance process automation is adopted by the fintech companies, even by banks, right? Then most important, blockchain technology. What is blockchain technology? It is a highly secure digital ledger platform. Means transactions are recorded digitally across multiple uh, systems. So we know that records are distributed. In that case, hacking become difficult and tampering also become difficult. Tampering means changing. So why this blockchain is important? Because in the international trade, multiple parties are there. Lots of documentation is there. Fraud risk is there. So blockchain solve many of these issues. And what are the benefits of blockchain? We get real-time review. Real-time review. Also, there is transparent factoring. Means invoices are visible in real time. Even correspondent bank need reduced. It also reduced counterparty risk. And small contracts automatically execute the terms. Transactions settle automatically. Even the regulators get real-time access. But challenges are also there. First are regulatory issues. Regulatory issues are there. Compliance requirements. It is important to follow the compliances, the rules and regulations. Right? And also suspicious transactions must be monitored. The transactions monitoring is important. And India, basically transactions which involve risky countries require careful scrutiny, carefully checking, right? So in the Indian Blockchain Infrastructure Company Private Limited, it formed in June 2021 by 15th scheduled commercial banks, and why it is established for inland LC transaction for domestic trade. So it basically helps in faster processing, lowering fraud risk, better connectivity, and it is built on Infosys Finacle Connect. Important one question can be there. And IDRBT suggested phased adoption of blockchain. Who suggested? IDRBT. Right? So that is the system of blockchain, like concept of the blockchain. So we can say this IDRBT says that adopt the blockchain. IDRBT is Institute for Development and Research in Banking Technology. It is called as right arm of RBI. Right. So what are the stages? Intra-bank usage, private blockchain within the bank is there. Interbank usage, applications that include cross-border payment, loan syndication, trade finance, capital market, centralized KYC. So application can include this also. Loan syndication means where multiple banks giving the loans, giving the loan to one person, right? And blockchain is used in cross-border payment also, for real-time settlement, for lower cost, for reducing fraud, and for direct bank interaction. And there are critical areas for blockchain adoption: cross-border remittances, corporate payment, person-to-person payment, and interbank payment. These are the critical areas. So what are the challenges that are there in the fintech? First is regulatory doubts. Means regulators are worrying about safety, about compliance, about stability, and also data security. Hacking risk is very high, and it is important to protect the sensitive data. And reputation risk is there, and reputation risk, even it requires high startup cost, and human touch is still required. Human touch is still required, right? So this is about the fintech. I hope that this thing is clear. Okay, let me just give me a second. I have to change the slide. Just a minute. I think now it is visible. So it is clear about fintech, blockchain, and all these things. I hope that this is clear. Any problem is there? Are the things clear about the concepts or any problem? So kindly let me know. Now let's learn about the letter of credit. What is letter of credit? Which we can say documentary credit. Letter of credit or documentary credit. As we know that documentary letter of credit is like a trust between exporter and importer. And in this chapter, we will learn about UCP rules and also about the Incoterms, which is important one, the important thing. So whenever the international trade happens, the buyer and seller, obviously, in the case of international trade, the buyer and seller are located in the different countries, and usually they don't know each other. So the biggest question is, if the seller asks, if I send the good, who will guarantee that I will get the payment? And buyer asks, if I make payment first, who will guarantee that the goods will be shipped? So this trust gap is solved by letter of credit. LC is bank promise to pay the exporter provided the exporter submit the required document as per the LC terms. So instead on relying only on the bank buyer's promise, the exporters relies on the bank itself. Like suppose if there is importer in the India and there is an exporter in the Germany, right? Now India's importer buys machinery from Germany. Germany exporter does not know the Indian importer. So exporter says, give me my payment assurance first. So importers approaches his bank, right? Bank issues an LC in the favor of exporter. Now exporter ships the goods and submit the document. And if documents are according to the LC, the bank will pay. So LC here substitutes the credit worthiness of the buyer, right? So this is why LC is most important payment instrument in the international trade, right? So why this LC is important? So for exporter, payment assurance from the bank, it reduced the risk of a buyer's default, easier financing from the banks. And for the importer purpose, payment made only against specified documents, evidence that shipment has taken place, and better control over trade transaction. So remember this thing, LC only deals with document, not with the goods. Bank is not responsible for the quality of the goods. They only responsible for the documents. So bank only examine documents. They do not physically inspect the goods. Now UCP 600. Since we know that LC is a worldwide concept now, right? LC is happening worldwide. So common rules are required, and these rules are framed by ICC, International Chambers of Commerce, Paris. And UCPDC is Uniform Customs and Practices for Documentary Letter of Credit. Right? Documentary credits. Or you can simply say this is UCP 600, and current publication is ICC publication number 600, which is effective from 1st of July 2007. UCP 600 6th revision. So why this UCP was introduced? Because you know that without common rules, uniformity is not possible. Different countries will follow their rules, so that will increase dispute and trade settlement becomes very difficult. So UCP provides uniform rules to all the parties, right? So you can see the evaluation in 1993 first UCP, 1951 revision is there, in 62 again revision, 74 again revision, 83 revision, 93 revision, 2007 final, not final, current version UCP 600. And the origin of UCP can be traced to the regulations which is prepared by New York bankers in 1920. Later, ICC adopted them and developed them as UCP. So what are the changes which are introduced in UCP 600? So questions can be there from this chapter, and so just listen carefully. So definitions and interpretation said it. Separate articles explain important terms clearly. Revocable credits are removed. Revocable credits are like in which the parties can change the terms and conditions, right? Without the consent of all other party. So UCP 600 recognizes only irrevocable credit. Lost document in transit means special provisions. Special provisions are introduced. We will discuss everything. And bank have to examine documents in just 5 days, right? And documentation must have to fulfill the requirements if even if the LC is silent, right? So documents have to fulfill their function. And if there is any mistakeful documents or any disparate documents, so clear provisions are provided for dealing in the disparate documents, right? Then what is LC? Is that clear? LC is a type of trust between the exporters and importers. You can learn like this, right? Payment is not made because goods are shipped. Payment is made when documents prove that shipment is done according to the LC terms. Now, who are the parties? First party is applicant, importer, buyer, person who requests to open the LC. He is the purchaser of goods. Beneficiary is the exporter, person in whose favor LC is issued. He receives payment under the LC. And issuing bank is the opening bank. Issuing bank is the opening bank, like buyer's bank. You can say this is buyer's bank. which issues LC and gives payment undertaking. And ultimate responsibility for payment lies with the issuing bank. What is advising bank? Which is located in the exporter's country usually. And what is the function of this? They authenticate the LC, they advises LC to the exporter, they act as the agent of issuing bank. And normally no payment obligation is there, they only advises and authenticates. Right? Now, confirming bank, which adds its own guarantee to LC. Exporter get issuing bank undertaking, confirm bank undertaking. So there are two payment assurances. And when exporter is not comfortable with the country risk, political risk, issuing bank risk, so they take these two types of undertaking of the confirming bank. Negotiating or nominated bank, they receives the document, they examine the document, they negotiates or pays under the LC. They are usually exporters bank. And reimbursing bank, they reimburses the negotiating or confirming bank. And they act as a settlement bank. Parties clear? Or any issue in the parties? So, now, how many types of letter of credit? First is revocable LC. What is the meaning of revocable LC? Like revocable LCs are those LCs which can be amended, which can be cancelled by issuing bank without the consent of all parties. Right? Exporters here get very little protection, and it give rise to disputes. So this is rarely used, right? So if negotiating bank already negotiated the document before the cancellation, issuing bank have to reimburse. Then we have irrevocable, which is one of the most common LC, and everyone use it. Why? Because it can't be amended, it can't be cancelled without the consent of all the parties, applicant, beneficiary, confirming bank. And all the LCs are deemed irrevocable according to the UCP 600, specifically stated. If the type is stated, then it is okay. If it is not stated, then they are considered as irrevocable LC. Like if LC is silent, so irrevocable LC. So remember this thing. Irrevocable confirmed LC. What is the meaning of this? Another bank adds confirmation. Two banks are liable now. Issuing bank, confirming bank. If issuing bank fails, confirming bank must honor the payment. So normal LC, one bank guarantee. Confirmed LC, two bank guarantee. Then transferable LC. Transferable LC. Beneficiary can transfer the LC fully or partly to another party. And transferred person is called second beneficiary. Beneficiary can transfer partly or fully LC to the second beneficiary. And they have to mention this word transferable. Can be transferred fully or partially, can be transferred to multiple second beneficiary. But second beneficiary cannot further transfer it. Only advising and confirming banks are not same. Okay, these parties I will explain. Let me explain this one, then I will tell you about the parties. Okay, first let's discuss about the types of letter of credit. So where I am, transferable LC. So see this thing, second beneficiary cannot further transfer it. And what is the red clause LC? It allows the exporter to receive advance payment before shipment. Advance payment before shipment. It helps the exporter to manufacturing the good, purchasing raw material, arranging the shipment. So the risk is there. If exporter takes advance and does not ship good, issuing bank suffers the loss. So historically, these types of clauses are there in the red color. So red clause is advance before shipment. Green clause LC means it is similar to the red clause LC. It is called extension of red clause LC, where exporter get the advance payment against receipt, undertaking and proof of warehousing of goods. If goods are already stored in warehouse, it is safer than red clause LC. But they have to show that the goods are stored in the warehouse. Then site LC. Site LC where payments are immediately done after presenting the documents, compliant documents. And it is also called document against payment. This type of LC is also called document against payment. Documents presented today, documents find compliant, payment made immediately. And usance and acceptance LC means in which payment made but at the future date. Right? These are called document against acceptance. If 60 days usance LC is there and documents are presented today, so bank accept the draft and payment is done after 60 days. And deferred is similar to the usance LC. Here basically payment is made on future specified date. In the usance LC, bill of exchange is drawn, but here no bill of exchange is drawn. In the usance LC, bill of exchange is presented. In deferred LC, no bill of exchange. In usance LC, future payment is there. Deferred, in deferred, we are also having future payment. Then negotiation LC. Negotiation LC means where the issuing bank undertake to reimburse a bank that negotiates compliant document, means bank give value for document and later get reimbursement. And then back to back LC. Back to back LC means which issued against another LC. Like example, suppose if exporter receives export LC, exporter need goods from the supplier. So bank issues another LC in the favor of supplier, and this second LC is called back-to-back LC. Right? Then, okay, we are having standby LC. It is called as a guarantee LC. Why guarantee LC? Because functions like a guarantee. Payment happens only if the applicant fails to perform the obligation. Like company promises to make payment, but company default. So beneficiary invokes this LC and bank have to pay. SBLC is a default protection. Right? And last one is revolving LC. Means it is used when supplies are made repeatedly in installment. Like monthly supply contract for 1 year. So instead of 12 separate LC, one revolving LC can be used for 12 months. Instead of opening a fresh LC every time, the amount get the refreshed automatically. So it saves time, it saves documentation, it facilitates the continuous trading. Right? So let's do a quick revision of all the parties. So first we have applicant. Just a second. Okay. Applicant is the importer right? Importer or the buyer, right? Who applies for the LC? He's the purchaser who purchased the goods. Then beneficiary, who sells the goods, like exporter. He's the exporter. Importer is the applicant. Exporter is the beneficiary. An exporter have to present the documents to the bank, shipping documents, then bank will do the payment to the exporter. An issuing bank is related, this is the importer, this is the exporter, and issuing bank is related to the buyer's bank, right? Basically, this bank is responsible for generating the LC. Then we are having advising bank, which is the bank of exporter, because obviously bank will communicate with each other. Issuing bank is not going to communicate with exporter. Issuing bank will communicate advising bank, who is the bank of exporter, that tells the exporter the LC is good, LC is following all the terms and conditions, and LC is saying this, right? Then we are having confirming bank. Confirming bank is like a who gives the guarantee to the exporter. Don't worry, if the issuing bank is not giving you the payment, I will give you the payment. You just provide the goods, you just do the shipment, right? There is one bank which is negotiated bank. This negotiated bank, which is nominated bank, who is responsible for examining all the documents. All the documents are according to the LC or not, right? And that is related to exporters bank. Then we are having reimbursing bank. Reimbursing bank is that bank which basically act as the settlement bank, which uh, which gives the money to the negotiating bank and confirming bank. Later, they take the money from the buyers, right? So reimbursing bank is the settlement bank. Settlement act as a settlement bank. Now it is clear, all the parties, or any doubt? Only four. These four are very important, and another three that act as the supporting bank, right? Supporting parties. So these are all the types of LCs. I think it is clear. So don't worry. In the PDF, I will upload a detailed definition of all these. Okay. So it will help you to understand the things clearly. UCP 600 is clear. UCP 600 is simple, are the rules by the ICC. Basically, they provide the uniformity at the global level. And we, the just one thing is there, one term is there, doc decks. What is that doc decks? Doc decks, when the disputes arises in the LC transaction. So there is the resolution platform which is provided by the ICC is DocDex, documentary credit dispute resolution expertise. Documentary credit dispute resolution expertise. Basically, it helps the in resolving the LC related disputes, right, without going to the court, right? So what are the main objectives of this LC UC 600? Simplify LC rules, reduce ambiguity, like double standard things, reduce disputes, make document examination easier, and following the global practices fairly. And UCP 500 had 49 articles, but UCP 600 is 39 articles. 10 articles are reduced. So what are these articles? So let's understand. Article 125. They talk about definitions, they talk about interpretations, they talk about independence of LC. Article 6 to 10. Article 6 to 10 talks about availability, expiry, issuing bank. Just you can just revise this thing. So confirming bank, like they include the rules regarding amendments. Document 11 to 17 are related to document handling. So in this we include definitions. In Article 6 to 10 are the operations of LC. 11 to 17 documents regarding document handling. In Article 18 it deals with commercial invoice. Article 19 to 27 are related to transport documents. Article 28 is related to insurance documents. Article 29 to 33 is related to operational tasks. Article 34 to 37 are about disclaimers, and Article 38 to 39 is for transfers, related to transfers and alignments. Every article is having their own importance, right? So some important changes which are introduced in UCP 600. UCP 600 does not apply automatically. LC have to mention the things, right? Revocable credits are removed, right? So yeah, in this, credit means irrevocable undertaking. This revocable credit are removed, right? Revocable type of credits are removed from this. So basically it Article 2 say credit is irrevocable. Even irrevocable is not written, LC is still irrevocable, right? So now according to the Article 10, we can't cancel, we can't change, we can't amend the LC without the consent of all the parties. Then definitions and interpretations are added about the all the parties, about the presentation and honor. So it helps in reducing disputes. Deferred payment undertaking strengthen means 7 and 8 clearly state that thing. Issuing bank and confirming bank have to honor the payment on the maturity. They have to give the payment on the maturity, even if the nominated bank has already discounted or prepaid the amount. So exporter payment protection becomes stronger here. And there is a greater responsibility of the advising bank now. Advising bank have to check LC advice to beneficiary is exactly same as the LC received. So it is important, and accuracy in advising is now more important. Just a second. Just a minute. So is that clear? Now amendments, like beneficiary have to communicate about the acceptance or rejection of amendment. Like if any amendment is there, so beneficiary have to communicate that he is able to accept that amendment or he is able to reject this amendment. But if no reply is there, so UCP 600 say if beneficiary present documents according to the amendment LC terms, it is treated as acceptance of amendment, right? Now 5 working days is there. bank have to examine in just 5 working days all the shipping documents, and a banking day means in which all the like normal bank is open. Non-matching data clarified. UCP 600 say data need not be exactly written, but it must not be conflict. Everything must be clearly satisfied, right? If LC is saying ABC Industries Private Limited, so if invoice is saying ABC Industries, so it is acceptable because there is no problem. So what are the rules regarding the documentation? I told you 5 working days are the are required for the examination of the documents, right? This period is now 5 days, and yes, generally 21 days 21 days from the shipment applies only to original transport document. Beneficiary and applicant address need not to be exactly same as LC. They must be in the same country. And whatever the telephone, fax number, they must be ignored. But consignor may be different from the beneficiary. Right? And apart from this, non-documentary requirements are ignored. Like there is a article 14 subsection G. Basically, bank only deal with document if LC containing any type of condition that is not supported by document requirement, bank will ignore it. Means, suppose if LC is saying goods should be excellent quality, so this is not the document based. Bank cannot verify the goods. Bank have to ignore that situation because there is a golden principle: bank only deal with documents, not with the goods. And complying presentation, once bank determines that documents are according to the LC terms, so settlement process starts immediately. And in the case of mistakeful documents, so bank can hold the documents pending further instructions, seek waiver from applicant, like any type of uh, like any type of the exact word, like waiver some conditions which are basically demanded by the applicant, to do some give some discount in on the documents, and return the documents and follow the prior instructions from the presenter. I'm not getting that correct word for the waiver, leave it. So there is a no provision for payment under reserves or indemnity. Like if any document is having mistakes, so in that case bank can hold those documents, or bank can say to the applicant, said these documents are there, these mistakes are there, I can ignore it or return the documents. These all things are in the hand of bank, right? And there is no provision for payment under any type of reserve or indemnity, and it is according to the UCP 600, right? And a document is treated as original if original signature is there, original stamp, original mark, original label is there, or typed, written, perforated, printed, or issuing stationery or expressly state original. So this type of document called original documents. In the case of transport documents, transport document have to show what is the name of the carrier, signature of the carrier, and in the case of charter party bill of lading, they can be signed by the charterer. Carrier name need not to be always appear. There is no need to specifically write clean to satisfy a clean onboard requirement. And in the case of insurance document may contain the exclusion clauses. It can be signed by proxy and may provide wider coverage than LC requirement. So if the LC requires 100% insurance cover and policy gives 120%, it is acceptable because greater coverage is acceptable. Right? 110% insurance. So Article 31 says fresh interpretation and clarification required in the case of partial shipment. Like partial shipment is some shipment is through the truck, some shipment is through the ship. So in that case, LC terms must be read carefully. That LC have to mention that a partial shipment is permitted. And if any document is lost in transit, so in that case, nominated bank find document is okay, other documents is okay, so they send them to the issuing bank. Document get lost during transit, so issuing bank have to honor or reimburse in that case if the nominated bank finds documents are okay. So it obviously protect the negotiating or nominated bank. And what is the meaning of force majeure? Force majeure when the controls are not in the hand. If any unforeseen event is there, like any natural disaster or any war. So if LC expired during this period, bank is not obliged to honor after reopening. No grace period is available in that case. When LC expire, that is expired. And if transferable credit is there, so presentation must be made through that transferring bank. Important one. If the letter of credit is transferred, so the presentation must be done by that transferring bank. Clear? So what are the responsibilities and the liabilities of the parties? Of different parties. So first we have applicant. Applicant tells clear instruction. Applicant have to request LC issuance, and most of the problems originate because applicant give poor LC instruction. So they are responsible to give clear instructions. Then issuing bank, most important party, that assess the applicant creditworthiness, that honor the presentation, that examine the documents carefully and decide within 5 working days and communicate the mistakes carefully. Advising bank is responsible for advising the LC correctly, verify the authenticity of the LC, informing the issuing bank if the authenticity is not verified, and informing the beneficiary if the authenticity is doubtful. Confirming bank adds its own payment undertaking, means they honor the complying document, they inform the issuing bank if the confirmation is refused. Confirming bank are the second guarantor. Then negotiating bank or nominated bank, they follow the UCP 600 rule, they check the documents, they negotiate if documents are okay, because wrong negotiation can result in financial loss. And then reimbursing bank are they are they basically act under the reimbursement authorization, and they are governed by URR 725. What is URR 725? Uniform rules for bank to bank reimbursement. An exporter receives the payment after presenting the documents. They submit the document according to the LC terms, and beneficiary cannot claim right arising from contract between the banks. Means they are responsible for presenting the documents after the shipment. These are the responsibility of this party. Now, what are the protection available to banks under the UCP 600? UCP gives extensive protection to the banks. Banks are not responsible for documents, for the genuineness of document, for the accuracy of the document content. Like, banks are not responsible for document genuineness or document. They are responsible for only checking the documents. They are not responsible for transmission risk, for the language risk, for the translation mistake, for the force majeure events, for the correspondent bank actions, for the foreign laws. They are not responsible for all these things. So these are the protection which is available for the banks under the UCP 600. Now, documents under the LC: scrutiny, crystallization, follow up, and safeguard for banks. What is this? In letter of credit transaction, bank deal with documents, not goods. We know that. And the entire payment decision depends on the documents, right? So document scrutiny is most of the important function, right? Correct documents are there, payment done. But incorrect documents are there, so there is maybe rejection will be there. So in the case of scrutiny, officer examine what? Knowledgeable in the UCP 600, aware of the FAMER regulation, they know about the UCP 600, right? They're familiar with the FTP, they are aware of the international trade practices. And while checking the document, the officer should check document is according to the LC terms, documents are internally consistent, shipment details match, dates are correct, all required documents are submitted. So documents should appear on their face to be compliant. That is important, how that the document is scrutinized basically. So what are the important documents under the LC? Important documents, first is bill of exchange, which you can say as a draft. Means a bill of exchange is a financial instrument through which the beneficiary ask the issuing bank to make the payment, like it is a formal demand for payment, right? In the case of site bill, immediate payment is there, and in the case of usage bill, payment will be on the future due date. So what is the meaning of commercial invoice? The invoice is the basic commercial document which is issued by the seller after showing that goods are shipped, quantity is shipped, price and total value is okay, right? Then even if the invoice amount exceed LC amount, negotiation is restricted only up to the LC value, right? Then bill of lading, one of the most important transport document. Most important transport document. It serves three purposes: receipt of good, evidence of shipment, and document of title to goods, right? And insurance policy, insurance certificate, it is there to protect the goods during the transit, right? And normally insurance amount should be 110% of CIF and CIP value, right? So every detail must be mentioned, and uh, the insurance must be 110% of the CIF and CIP value. So these are the requirements in this. CIP is the carriage and insurance paid. It is a global standard, and cost, insurance and freight is CIF. Certificate of origin means basically you can say in the case of certificate of origin, documents certifying the country where goods were manufactured or originated. Originally by Chamber of Commerce and authorized independent authority. And packing list, weight list and other certificates. In this we can include packing list, weight list, beneficiary certificate. All documents should match each other, match the invoice, match the LC terms, and as well as any consistency can create mistakes. Now crystallization, one of the important topic. Why crystallization? What is crystallization? When importer fails to retire import bill within the permitted period, the foreign currency liability is converted into the Indian rupees, and this conversion is called crystallization. Bank cannot keep foreign currency exposure open for indefinite period. So liability is converted into the INR. This is crystallization. And in the case of site bills, where the payments are immediate after receiving the document, bank keep the liability in foreign currency as per their internal policy and FEDI guidelines. An importer does not retire document within that period, so foreign currency liability will be converted into the INR. Suppose if the import bill is US dollar 10,000, importer fails to pay, so bank convert US dollar liability in the INR, and that conversion is called crystallization, right? And in the case of usance bill, that take place on due date. Crystallization happens on due date. In this happens on the holding period, but in the usance bill on the maturity period. And after the crystallization, importer has a rupee liability. And if import loan exists, amount is debited to the import loan account. If no loan exists, bank follow up directly with the importer. And recovery process becomes similar like recovery of advances. And in the case of interest, before crystallization, there is normal interest. After crystallization, penalty interest may be charged, penalty may be charged. Right? IDPMS is clear. What is IDPMS? I told you. So what are the safeguards for the banks while they are handling the LC? What are the safeguards? Like, you know that LC is completely a non-funded facility, right? It is a non-funded facility, but can become a funded exposure if default by the importer. So bank have to be cautious. Before sanctioning the LC, bank have to conduct proper due diligence. They have to follow KYC norm. They have to understand the importer's business nature. They have to verify genuineness of transaction. They have to assess the repayment capacity. Right? Because here bank have to be careful. Right? So if the large value transactions are there, then in that case, extra question is required, extra caution. Transaction value suddenly increases, or customer offers 100% cash margin, or business volume sudden spike. So that may be unusual activity, right? And it is important to do overseas seller verification. Bank should obtain credit reports on overseas supplier. Why? To avoid fraud and bogus imports, like not genuine imports. And staff handling is responsible. Whatever the staff, they know, they have all the skills, they know about the FEMA, they are familiar with the UCP, right? So what are the transactions are there in the LC? LC reduces risk but does not eliminate it. And common risk are there: document mistakes, legal risk like court orders may stop the payment, and country risk are there, currency risk are there, exchange rate fluctuations, quality disputes, buyer say I am not doing payment because goods are not good. Fraud risk is there, fake suppliers can be there, fake documents are there. So what are the precautions for the importers? They have to verify the supplier, they have to obtain the credit report, they have to include proper LC clauses, they have to ensure goods are importable, they have to know about the foreign rules, and they are know how to protect the large exposures. And same, there are the precautions for exporters also. What they have to prepare documents exactly according to the LC. They have to avoid mistakes and ship goods as per the contract. They have to understand importing country regulations, and they have to submit the documents within the time period. right? Now, most important and most famous and most favorite topic of the IBF, that is Incoterms. Suppose if there is exporter in India sells the goods to the buyer in Dubai. Now the question is there, who will arrange transport? Who will pay freight? Who will arrange insurance? Who will bear risk during the transit? Who will clear custom? Is these all responsibilities are not defined clearly, so obviously disputes can arise, right? Disputes can arise. So Incoterms are internationally accepted terms that define responsibilities of the buyer and seller, cost sharing, risk transfer point, delivery obligations. Incoterms apply to the contract of sale. Incoterms do not apply on the contract of carriage. They govern the relationship between buyer and seller, right? So you can see the complete chart is there, where all the Incoterms are written. So let's understand one by one. We know that XW to DDP, the seller responsibility keep increasing and the buyer responsibility keep decreasing. Four broad terms of Incoterms are there mainly. In this, first is we are having departure terms. Departure terms, and in this X works. First is X works. X works, which we can say EXW. So seller simply makes goods available at his premises. Buyer here take the responsibility from here. Seller responsibility is just manufacturing the goods, keep the goods ready. And buyer responsibility is loading, transport, export clearance, freight, insurance, import clearance. So here the maximum responsibility is on the buyer, right? Now, main carriage unpaid terms. Under these terms, seller deliver the goods to the carrier and ship, but does not pay main international freight. And in this we have FCA, that is free carrier. So basically, seller deliver goods to carrier nominated by buyer. Risk transfers when goods are handed over to the carrier. But buyer can instruct the carrier to issue on-board bill of lading. So that helps seller in LC transaction because bank require on-board LC. Then next is free alongside ship, FAS, where seller place the goods alongside vessel. Risk transfers when the goods are placed beside the ship. Buyer bears the loading and onboard cost. Then we have free on board, FOB, free on board. Seller load the goods on board. You can see FAS here, loading origin. Here the seller load the goods, risk transfer when the goods are on board. So it is used for sea or inland waterway transport. For the sea or inland water transport. Right. Then we are having main carriage paid terms. In this, seller pays international freight. First is CFR, cost and freight. Here seller pays freight, buyer bears transit risk, right? Then CIF, cost, insurance and freight. Seller pays cost, freight and insurance up to the destination port. Seller arranges insurance and risk transfer at the shipment stage. Clear? And then we have CPT, carriage paid to. Seller pays carriage charges. Seller pays transport cost but risk transfer earlier. Then we are having CIP, that is carriage and insurance paid to. Seller pays transport, insurance up to the destination. That's why these are the main carriage terms. But now there is a change. Insurance requirement is upgraded. Basically, now there is an institute cargo clause A in which all the types of risk are covered. Now we are having arrival terms. First is DPU, means delivery at place unloaded. Here seller is responsible for unloading the goods at destination. And DDP is there, which is delivery duty paid. Seller bears all the responsibilities. Seller bears all the things: freight, insurance, custom clearance, import duties. So basically, there are some important changes in the Incoterms. FCA and onboarding bill of lading means buyer can instruct carrier to issue onboard bill. Own transport is allowed. Now parties can use their own transport, right? And earlier there is a limited coverage regarding to the institute cargo clause C. Now all risks are covered. DAT replaced by DPU. First is delivered at terminal. Now DPU is there. Delivery can happen at any place, not necessarily at the terminal. And cost structure is clarified. Basically, costs are borne by buyer and seller. These are clarified in the Incoterms, and this reduces the dispute, right? And security requirements are also included. Growing international concerns regarding cargo security or container screening, supply chain security, these all have been incorporated. So security requirements are tighter now if comparison to earlier time, right? So I think this chapter is completed. Okay, so DC is also completed. Now just a second. So tell me one thing, can we continue or can we do one chapter more, or we can continue tomorrow? Tell me fast about this. Can we do one more chapter or we'll continue in next class? What is the majority saying? Tomorrow. Okay, I can understand you also have to go office. Okay, so don't worry, we will take some time tomorrow because C&D modules are small. I think we have to take one more class for the numericals and case studies, but try to attend 7 a.m. class on YouTube, where I am just focusing to doing all the numericals and case studies on our YouTube. So that will help you out, right? Because 7 days covering all the things is difficult, but we will do just a talk of 7 days, don't worry. Okay, so just let's continue tomorrow, right? And I am uploading the PDF in half hour. Give me half hour, then I will upload. Okay, Telegram scanner is there, you can check the first class PDF, you will get there. Okay, okay. Shiva sir, continue. Okay, sir, we will continue from tomorrow. Just read these things. I think 4 chapters are left from module B. So after completion of this class, I will upload in half hour, the PDF. Okay. Okay, everyone. Thank you so much. Just revise it. That is enough. You will surely crack the exam. So let's meet tomorrow. Be confident and take care. And if any issue is there, you can ask me in the community. Let's meet in our next class. Till then, take care and have a good day all. Thank you, everyone.